Level 1, $10. That's all it took. $10 sitting in a brokerage account on a Tuesday morning, about to be pressed into a stock market that has turned ordinary people into millionaires and turned overconfident ones into cautionary stories. The question was never whether the market could change someone's life. It always could. The question was always whether the person on the other side of the screen would survive long enough to let it. The first trade feels like standing at the edge of something that has no visible bottom. There's a search bar, a list of tickers, a number that represents everything you've decided to risk. You type in a name you recognize, a company you've bought something from, a brand that feels safe because it's familiar. You tap buy, the screen confirms the order, and just like that, you're in the market. But you're not an investor yet, not really. You're an observer with skin in the game, and there is a significant difference. The observer watches the screen like it owes them something. They check their portfolio before breakfast and again before sleep. A 2% gain produces something close to pride. A 3% drop produces something close to dread. The numbers are speaking a language you don't yet understand, but your nervous system responds to them anyway. At this level, the market is teaching its first and most important lesson, one it will repeat at every stage in increasingly expensive ways for as long as you're willing to listen. The lesson is this: your emotions are not your edge, they are your liability.
Level 2, $50. A few weeks pass. The account has moved, up a little, down a little, and currently sitting close to where it started. You've added money, $50 this time, and something has shifted, not in the account, but in the approach. You've started reading articles, forum threads, the occasional video explaining what an index fund actually is. And somewhere in that reading, a concept begins to crystallize. The idea that instead of betting on a single company, its management decisions, its product cycles, its quarterly results, you could buy a single instrument that holds a piece of hundreds of companies at once. An ETF, an exchange-traded fund that tracks an index, one ticker, instant diversification across the entire market. The logic is almost uncomfortably simple. Instead of trying to pick the winner in a race, you buy a stake in the race itself. At $50, you don't buy much, a fraction of a share maybe, but the concept is lodged now in the way you think about money. You're no longer looking for the company that will go up. You're beginning to understand that the entire market, over time, has always gone up. Not in a straight line, not without violence, but upward. Always, eventually, upward. This is a quiet but radical shift. Most people spend their entire investing lives trying to beat the market. The investor who learns early that matching the market is already extraordinary has saved themselves decades of expensive mistakes.
Level 3, $100. At $100, a new habit takes hold: consistency. Not excitement, not strategy, just the mechanical discipline of adding money on a schedule regardless of what the market is doing that week. This is dollar cost averaging, though most beginners don't know the name for it yet. They're just doing it instinctively, putting in a fixed amount every month because it feels manageable and because stopping feels like giving up. But what they don't realize is that this habit, this invisible routine of buying whether the market is up or down, is one of the most statistically reliable methods of building long-term wealth ever documented. When the market drops and their $100 buys more shares than it did last month, they are uncomfortable. When the market rises and their $100 buys fewer shares, they feel slightly cheated. But both reactions are wrong, because the investor who buys consistently through volatility is not a victim of the market's movements. They are quietly benefiting from them. There's a stillness required at this level, a willingness to do the same thing over and over without seeing dramatic results, and that stillness is harder than it sounds. The market is never silent. There is always news, always a forecast, always someone explaining why now is the worst possible time to be invested. The investor who learns to act anyway, to buy their index fund, close the app, and walk away, is building a discipline that will carry them further than any stock tip ever could.
Level 4, $500. Then the market breaks. Not a small dip, a real decline. The kind that appears in the news. The kind that makes family members send worried texts about the economy. The kind where the portfolio goes from green to deep red in a matter of days. The $500 account becomes $420, then $400 even. The loss is still modest in dollar terms, but it doesn't feel modest. This is the first real test, and most people fail it, not because they panic, but because the panic is completely rational. The screen is red. Experienced investors are selling. Financial anchors are using words like correction and uncertainty and historic volatility. Everything in the environment is signaling danger. So they sell. They tell themselves they'll get back in after things stabilize. They'll wait for the bottom. They'll reinvest once it's clear the worst is over. But the market doesn't send a notification when the bottom arrives. By the time things stabilize, the index is already 12% above where they sold. They bought fear, they sold at a discount, and now they're sitting outside a market that has resumed climbing without them. The investor who holds, who does absolutely nothing, who watches the red and feels the fear and keeps their hands still, doesn't just protect their position. They earn something that cannot be purchased, proof that they can be trusted with their own money, that the plan matters more than the feeling, that discipline is not an idea, but a behavior, and behaviors are only revealed under pressure. Level 5, $2,000. The account has grown, not dramatically, not through luck or a brilliant trade, through the slow accumulation of regular deposits and the quiet compounding of returns over months that eventually became more than a year. At $2,000, the investor opens a calculator for the first time with real intention. They type in the numbers they've been working with: $300 a month, 9% average annual return, 30 years, and they press calculate. The number that comes back doesn't seem real, not because it's impossibly large, but because it comes from something so ordinary: $300 a month. Not a windfall, not an inheritance, not a startup. $300 repeated at an average rate of return the market has historically produced across generations of investors. And the result over 30 years clears $500,000. But that's not what stops the breath. What stops the breath is the shape of the growth. The first decade produces modest results, something you could almost do with a savings account. The second decade starts to pull ahead, and the third decade curves sharply upward, producing more wealth in its final years than the first 2 decades combined. This is compounding, not as a concept in a textbook, not as a word in a financial article, as a lived, visual, visceral understanding that time is the most powerful variable in any investment equation, more powerful than the amount, more powerful than the rate. Time is the ingredient that turns ordinary into extraordinary, and it is the one resource that cannot be replaced once it's spent. The investor who understands this, not intellectually but in the bones, changes their behavior. They stop thinking about what the market is doing this week. They start thinking about what time is doing with their money. Level 6, $10,000. The portfolio has crossed 5 digits, and something in the way the investor relates to it has shifted. It is no longer a number to watch. It is something to cultivate. At $10,000, dividend investing enters the picture, not as a replacement for growth, but as a complement, a second dimension of return. Companies that pay dividends are in effect rewarding shareholders for the simple act of ownership. Quarterly payments that arrive in the account whether the stock moved up or down that month,
real cash, not a paper Dane, cash. At a 3% yield on $10,000, those dividends amount to roughly $300 a year, small enough to dismiss. But the investor at this level doesn't dismiss it. They reinvest every dollar automatically, buying more shares, which generate more dividends, which buy more shares still. The cycle, once started, is self-reinforcing. There is something psychologically different about receiving income from a portfolio rather than just watching its value fluctuate. The investor is no longer entirely dependent on the market going up for the investment to be working. Even in a flat year, the dividends paid. Even in a slightly down year, the reinvested dividends purchased shares at a discount. The portfolio has taken on a second heartbeat. This level also demands a deeper look at what is actually being held, not just whether it's going up, but why. The investor begins studying companies the way a business owner studies competitors, looking at the history of dividend payments, the payout ratio, whether earnings are growing steadily enough to support future increases. The portfolio is becoming intentional in a way that the early instinct-driven purchases never were. Level 7. $25,000. $25,000 brings with it a temptation that is difficult to recognize because it feels like sophistication. The investor has learned enough to be dangerous. They understand valuation. They can read an income statement. They've started identifying patterns, sector rotations, earnings cycles, macroeconomic signals that seem to predict market movements. And they start acting on that knowledge, more frequently, more confidently, rotating out of positions before earnings, moving into sectors ahead of anticipated catalysts, treating their portfolio like an active instrument rather than a long-term engine. Some of these decisions work. A few of them work spectacularly, and that is the problem. When an active decision produces a strong return, it is almost impossible to distinguish between skill and luck in the moment. The feeling of being right is identical in both cases. And so the behavior reinforces itself. More trading, more conviction, more exposure to individual positions based on analysis that feels rigorous, but is operating in a market already priced by institutions with 1,000 analysts and algorithms and resources that no individual investor can match. Over time, the data emerges. The active version of the portfolio is underperforming the index funds that were left untouched. Not because the investor is foolish, because the market, at its most basic level, is an aggregation of everything already known, and consistently outguessing it is a game that almost no one wins over the long run. The real maturity at this level is not becoming a better trader. It is recognizing when to stop trading, to hold more, to trust the structure, to let the engine run. Level 8. $100,000. $100,000 changes the emotional texture of investing entirely. Every percentage point is now $1,000. A 10% correction, common, historically routine, represents $10,000 in paper losses over a matter of weeks. And while the investor knows, rationally, that paper losses are not the same as realized ones, rationality and the felt experience of watching $10,000 disappear are not the same conversation. This is where risk management stops being a concept and becomes a practice. The portfolio is restructured with intention, more diversification, not just across individual stocks, but across asset classes, across geographies, across sectors that don't move together. The goal is not to eliminate loss. Loss cannot be eliminated. The goal is to ensure that no single event, no single sector collapse, no single bad call can materially damage the whole. The investor starts to think about correlation, about the difference between holding 10 tech stocks, which will all fall together in a tech sell-off, and holding a mix of assets that respond differently to different pressures. International equities, dividend-focused funds, different categories of growth exposure. The portfolio starts to resemble something an architect would design rather than something assembled by instinct. At this level, the investor's biggest enemy is no longer ignorance, it's overreaction. The impulse to do something, anything, when the portfolio moves sharply. The investor who can sit with $100,000 in a falling market and simply hold the plan is operating at a level of emotional intelligence that most people, regardless of how much they've studied, never fully achieve.
Level 9. $500,000. There is a paradox that lives at the center of serious, long-term investing. The further along the journey, the less the investor actually does. A $500,000 portfolio is not managed through constant attention. It is managed through structure. Contributions are automated. Dividends reinvest without a decision being made. Rebalancing happens on a calendar, not in response to the news. The portfolio has its own momentum now, and the investor's primary job is to protect it from their own impulses. The investor at this level checks the account less often than they did when it held $500, not because the stakes are lower, they are obviously higher, but because the relationship with volatility has changed. What once felt like danger now feels like weather. The market will have bad days, bad quarters, bad years. The investor has seen enough of them to understand at a cellular level that the recoveries always came, every single time. This is not complacency. It is experience translated into behavior. The investor has a written investment plan. They follow it when following it feels right, and they follow it when following it feels wrong, because they've learned that the feeling is almost never the reliable signal they once believed it was. The quiet at this level is earned. There is no drama in a well-structured portfolio, no urgency, no anxiety, just the slow, relentless accumulation of compounding returns across a timeline that is still, at this stage, far from over. Level 10. The path to 10 million. This is not a level reached in a moment. It is reached in decades, through hundreds of deposits that felt too small to matter, through market crashes held with clenched teeth and steady hands, through the discipline of reinvesting dividends when spending them would have felt more immediately satisfying, through resisting the seduction of active trading at the exact moment when the portfolio was large enough to make it feel meaningful, through understanding, in a way that changed behavior, that time was always the most powerful force in the equation. The investor who reaches $10 million in the stock market is not remarkable because they were smarter than others. They are remarkable because they were consistent when consistency was hardest. They bought when the news was bad. They held when every headline said sell. They trusted a process they couldn't always see working through years when the results were slow and the doubts were loud. At some point, gradually, then suddenly, the way compounding always eventually feels, the portfolio stopped being something they were building and became something that was building itself. Returns generating returns, dividends compounding across decades of reinvestment, the machine running quietly in the background while the investor lived their life. $10 million in the stock market is not a destination. It is the consequence of one decision made correctly and then made again and again across years of market cycles and life changes and every temptation to do something different. The decision to start, the decision to stay, the decision to trust time more than fear. The market was never the obstacle, it was always the vehicle. The only thing standing between any investor and what the market can eventually produce is the version of themselves that panics, that doubts, that waits for certainty that never arrives. The ones who build real wealth learn to move without it.